we're dealing with some trickery because now we've got the sun goes down.
Shouty got stung by a bee just now. Look at her face.
Oh no, she's walking obviously.
Yeah.
Oh my god.
With the coffee from Dairy Barn.
Oh no. I got stung by a hornet like on my hand a couple of years ago. It hurt a lot more than I remember.
How do you know it was a hornet? Was it wearing turquoise?
Michael Batnick.
Who's that?
Barry.
Oh.
Yo. How literally did you get that photo of the front? Barry texted me a picture of the front of my house. How did you do this?
This is great. This makes great TV.
All right.
What's going on in front of your house?
It's holiday season. All right, I'm about.
I wish you paid a dividend. I'd buy stock in it right
Yeah,
now.
yeah.
What book is it? Okay. All right. Fascinating. All right, I'll call you later.
That's quite fascinating, Barry.
Yes, I am. Actually.
Check
I
one,
love
two,
you.
check
Try and
one,
stay
two.
like 3 inches.
Did you say love you to get off the phone with him?
Yeah.
You don't say that to me. Just saying. All right. How we looking, everybody? It's a very important man we have here. Let's not keep him waiting.
Yeah, please.
Put my mic on!
I was in this room at a previous iteration, a very early iteration of your podcast.
Is that right?
Yeah, you and Barry were interviewing Jeff Saw it. I didn't even know what I didn't even know what a podcast was.
Oh, and you came for that?
Yeah, 'cause
oh, that's
we were
so
doing
funny.
something. It's
I don't
some-
remember
Where?
that.
Where?
Yeah,
When
I
was
was
it?
just
Here,
right over
here,
there.
here.
Yeah,
I remember
and
having
Barry?
Jeff here.
yeah. I was not. I was busy, but I was just sitting over there
This is
playing
like
with my phone.
2017 or something, 2018, like very, very early.
Huh.
So,
Yeah, it had to have been 17.
yeah. Oh, that's so funny. How's Jeff doing?
He writes on Mondays only.
Okay.
That's all he does is just write one column.
He's just such a sweetheart of a guy. I really liked him.
Where did he write for? Where did he work?
He was at Raymond
Raymond
James for
James.
like 100 years. And then he came to our firm for a few years and he started a newsletter called Sought Strategy.
Yeah.
He's a great
I remember reading it
great,
back in the day.
great mentor.
He was one of the first mainstream strategists to incorporate a lot of technical analysis and then combine it with macro and fundamental. I feel like a lot of them do it now, but he was doing that a long time ago,
His
right?
dad taught him Dow theory.
Okay. Oh, that's interesting.
Yeah. So he still follows his dad's version of Dow theory.
Okay. All right. Oh, we got the color block. Hey, Nicole, what episode is this? We don't know?
Yeah.
All right.
Don't rush it. Duncan, we got to add No More Mr. Nice Guy to the button, right? Did you hear Ben's No
Yes.
More Mr.
Yeah, we
love
can do
it.
that.
Very confident, very confident.
Is that wouldn't that be good? No More Mr. Nice
All
Guy?
right. What episode are we doing?
Very confident. Nice.
Today's episode of the Compound and Friends is brought to you by Crane Shares. The global luxury market is projected to reach $570 to $615 billion by 2030. Unbelievable. Well, it's more than double its size in 2020. So KLXY gives you access to global luxury brands such as LVMH, Hermes, Ferrari, Pernod Ricard. I doubt I'm getting that right, but hey, that one too. And be sure to check out the Talk Your Book that Ben and I did a couple of weeks ago with Brendan Ahern on the global luxury market.
118, ladies and gentlemen, 118. Big show today. We have a very special guest. I'm so excited about this. Kevin Simpson is the founder and chief investment officer of Capital Wealth Planning, a $9 billion asset manager based in Naples, Florida. Welcome to the show, Kevin.
Good to see you.
Capital Wealth Planning's enhanced dividend income portfolio SMA strategy is 5-star rated by Morningstar. Is that like Michelin stars? It's pretty close to as important, right?
Yeah, it's a big deal.
Okay, so let's not jeopardize them today. So it's a dividend growth portfolio with a tactical covered call writing component. Pretty novel. There's not a lot of those out there, right?
There's more and more every day, but
Okay.
not
Covered call strategies are so hot right now.
No, but covered calls coupled with
Yeah.
dividend growth I find that interesting.
Thank you. Yeah, we were the I guess when there's so many that come out now today in any covered call capacity, it helps all of us in the industry.
Okay.
When I started, there were like 3.
So this increased like just overall awareness of this as a strategy.
Yeah, as an asset class, absolutely.
Okay, this is an SMA.
We have an SMA. We also run it in an ETF clone. The symbol is DIVO. It's the Amplify version of the SMA in a ETF wrapper.
Okay.
And we run an international version of it that we started about a year ago. It's iDevo, and I have Tim Seymour, who you probably know pretty well, as a international consultant on the iDevo product.
Oh, that's smart. Yeah, Tim spent a lot of time overseas, and he knows foreign markets pretty well.
Better than me.
Better, yeah, definitely better than me. All right, shout out to Tim. Congratulations. So you also have a podcast, and it's called Covered Calls. Great name. How long have you been doing the podcast?
We started about 2 years ago. It is not nearly this operation.
Okay.
But it's fun, just one-on-one conversations, mostly with people from CNBC.
All right, very cool. We're going to link to all that stuff in the show notes. I wanted to start this week with it's amazing. We're starting to get the first of the 2024 strategist pieces, which is always like a fun time of year. And I don't like knee-jerk hate on these things. I don't invest based on them. I don't think anyone really does.
You can't.
No, but it's just good to like get a sense of like what people are thinking and why. So I find this stuff to be interesting. I used to make fun of it. Now I'm like, all right, let me see what the vibes are. So I don't know. Do you look at this stuff or not really?
I make a point of trying to look at certain people and avoid others.
Okay.
But I think it's interesting. And when you have a rising interest rate environment like we had going off as a zero interest rate base and throwing 550 basis points of yield, it's really hard to make money in equities. So if you look back at 2022 forecasts or 2023 forecasts, I doubt there were many people that said, well, for the whole duration of this 2-year period, there's going to be 7 stocks that go up.
Yeah.
So I take every strategy call with a grain of salt.
Okay. Yeah. I mean, we had more than 7 stocks going up, but the 7 stocks that did happen to go up were the ones that had to, and they did.
It's much more broad than 7 names, but
right.
It seems fun to just say the Magnificent Seven.
I agree.
So I don't know what the acronym is for the
All
Cool
right,
23.
This is UBS. The Federal Reserve will cut interest rates by 275 basis points next year, nearly 4 times more than what markets are pricing in, according to strategists at UBS. A continued decline in inflation will enable the central bank to start easing policy as soon as March, with rates likely to be cut in large increments, typical of an easing cycle. So they're thinking like 50 and 75 basis point cuts. This is not consensus.
I was told that we were going to be higher for longer.
Well,
very many times.
Nobody wants to listen. So clearly we're going to have rate cuts in March, according to this, which is great because then the stock market can go up. I think that the thesis that I have is like almost the complete opposite of this. And when you talk about higher for longer, it makes sense because how many times has Chairman Powell come out and said it's higher for longer? Like pretty much every time. And the CPI number the other day was really, I thought, a catalyst, whether it was going to be good or bad. So it didn't disappoint. We saw a big market to the upside. But it didn't do anything in terms of the forecasts of Fed funds rate on CME Group's survey. You can take that with a grain of salt, too. Right after the FOMC meeting, they thought that Chairman Powell was really dovish. And he came out and said, no, I'm not. And then we had
No, I'm not.
Yeah, then we had the CPI report yesterday. It just took us back to where we were.
Right.
So the idea of rate hikes in March, to me, seems almost ludicrous if you think that we're still 100% off of where the Fed wants to get inflation. 9 to 4% is really cool, and it's awesome. But going from 4 to 2 by March, to me, that just seems like almost impossible. It would
So
be
this
great
is a
if it
London-based strategist for UBS. The New York-based will probably have a different call, and then you could just average the
But
two.
they're doing it not because they see a recession, but because they see just like a super duper soft landing, like the softest landing of all time, Charmin soft.
This particular piece talks about a global decrease in yields, which I thought was even more fascinating.
Yeah.
Because I think if you have the best economy in the U.S., there's going to be more problems in Europe. And what they're saying is there's not going to be a recession anywhere on the planet.
The strategists expect the benchmark federal funds rate to fall to between 2.5% and 2.75% by the end of 24 and see the terminal rate at 1.25% by early 2025, based on an expectation the U.S. economy will slide into recession. I mean, I guess historically it's not that. If we do slide into recession, then 1.25% sounds reasonable. So it's a big if.
Well, it's a 50-50 probably whether you get the recession or not, and all that thesis would play out, but it just wouldn't happen in that time frame.
Yeah.
I think you just have to push 6 or 9 months into the future to kind of get this to come to fruition, even if there's a recession. I don't think they come to the rescue right away.
Well, like the stock market, they take the stairs up and the elevator down, right? Like they cut a lot quicker than they raise.
Yes.
There's not a lot of gradual cutting because you're cutting in response to something that you think you really need to react to.
And that's why this thesis of talking about it being a recession makes sense, that there would be a rapid cut. I just think that the time frame is incredibly premature.
So if we could play this out where we get a recession and corresponding rate cuts, I know I'm asking the impossible. What happens to the stock market?
Obviously goes up. Did you not learn anything? What stock market have you been watching? All right, go ahead.
No, it goes down before it goes up.
Well, it
Sure.
depends on the magnitude of the recession, because if you have a short, well, first of all, we won't know if it's a
a
recession
dovish-
until
all right,
afterwards.
it's a
right?
dovish
The
recession.
bigger the
Yeah,
recession,
exactly.
the quicker they cut rates.
It's a good recession.
It's a benign recession. This is my call.
So, but the problem with a benign recession or a severe recession is we don't know until after the fact. So when the National Bureau of Economic Research comes
Yeah.
out and tells us we were in one, then by then we can all kind of exhale, and then the stock market probably would go up. But I think that any economic contraction hurts earnings. It also hurts multiples. And what we get excited about, why the stock market is so reactive to anything having to do with interest rates and Fed cuts, is like, well, if you have lower interest rates, then you can have multiples that are higher, and you have higher margins, higher profits, and it's all good. But nothing's linear, and that's the problem. Any little data point, we think, all right, rate cuts tomorrow. And looking at the Fed dot plot, and you can laugh if you want, because I would, they have one cut for 2024.
Yeah.
Like that's what they have priced.
But that's so high frequency. They change. It changes every month, and it's never right.
Well, they had one rate hike in 2022.
Exactly.
So
Right.
that's why I said you can laugh at that
Yeah, yeah.
comment, but I think that higher for longer is serious, only because the Fed doesn't want to make the mistake of raising them too quickly, prematurely.
Do you think they'll tolerate? So you think they'll tolerate like 4.5%, 5%, pushing almost 5% inflation before they start? Unemployment.
I know what you
before
meant,
they start cutting. I don't know how I feel. I'm not sure.
I doubt it would get to 5.
In an keep in mind, it's an election year. There's going to be some pressure.
Well, it's a non-political body.
Sure. Okay. Market bets for Federal Reserve policy easing next year. We have this chart. Daniel, are you doing the charts yet? Yeah.
There we go.
See 'em? All right. Let's see. Well done. This is your first. This is your first chart. Guys, nobody get upset. John is in Brazil on vacation. Nobody get upset. All right. So this is 75 basis points worth of rate cuts by December 2024 is what traders are currently pricing in, which of course is also subject to a lot of volatility. But this is where the market is today: 3 rate cuts, or 3 25 basis point rate cuts at least by next year. So you think this is close or far off?
I'd probably say 1 or 2, but I wouldn't be surprised if there was 0.
Are they-
Josh. I mean,
right.
there doesn't have to be a
They
rate
might
cut.
even just be ceremonial, just to signal that things are normalized.
And that could just be 1 rate cut in November of next year, like literally a year away.
Well, the question is the size.
Small. The first one should be small. I don't think that they're going to have that elevator on the way down right away.
Gunlock says something similar. Gunlock's like, they're not going to cut 50. They're going to cut 250.
Yeah, but he thinks it's going to start in March or
What is this?
June or something.
What is this? Why is everyone saying March? Is that just like
Because we don't want to wait for anything. Like we've waited 2 years. Like,
Yeah.
let's get on with it. But the problem is you can't. Not with the wage growth, not with the inflation the way it is, and they're not going to make the same mistakes that Volcker did in the 70s or 80s, and even in '95. I mean, I was in the business. I don't remember it being like a super soft landing, but they were just tweaking. Like they cut them a little bit.
well,
they
also
put 'em
there
up
was
a little
no there
bit.
was no notification. They would move rates and you would find out 2 weeks later.
It's awesome.
Yeah, now we have press conference like they just won the NCAA championship every month.
I mean, there's something to it. I have friends that are just Fed watchers that like pay more attention to that than they do the NCAA. They just text me all day long when it's Fed day. But
Right.
we also weren't coming off a 0 interest rate base in '95,
Right,
and
true.
certainly not in the '70s or '80s.
I'm forecasting for December a December to remember. I'm making the Lexus forecast.
24, 25.
Yeah, yeah.
The NASDAQ 100 is less than 5% away from an all-time high. Do you think that the market is already pricing in Fed cuts?
Yeah, absolutely.
You do.
Well,
Oh, wow.
100%. Because look at what happened with the CPI number. I mean, that didn't
Well,
change.
all right, so let's hear. I want to hear what you thought about the CPI number and the reaction. Did we overreact? It was an amazing day for stocks. One of the best days for certain areas of the market. All the most rate-sensitive stuff led. Small caps led.
Yeah, like 5%
Dividend
or
payers,
something.
all the lagging shit that nobody wanted to look at all year. Not that they came back to their highs, but they just they got off their lows meaningfully, and we seem to be holding that so far. What's your take on that reaction?
Well, 0.1. It used to be a rounding error. Like that was 0.
Yeah.
And now all of a sudden it was this, heroic.
The print
relic.
itself.
Yeah.
Okay.
So I don't think it's that big a deal. But the good news is what's great about it is that it didn't show that we were back into an inflationary period because you didn't want to see a big jump up. You just need the trend to come down, even if it's not linear. You just don't want people to think, oh no, inflation's coming back. Now the Fed has to raise rates. Forget cutting rates.
Retail sales were like just okay. Like we didn't get like a screaming hot retail number.
The going back up part, remember Larry Summers' chart crime from a few months ago that everybody went nuts about? He overlaid today's CPI with the 1970s. It said, well, just wait. It's remember that?
Yeah.
It's not.
I don't think he
1970s.
tweeted yesterday. All right. So you don't think we reacted too much to it? You just thought it was like just an okay report, and a lot of stocks just like got a lifeline.
The whole 2 years since they've been raising rates is still just consisting within this range-bound environment. Whether it's 41.50 or 45.50, it doesn't, anywhere in there you can make a case that stocks are fairly valued. Because to me, it's a pretty easy concept. Like, how much does the company make, and what multiple do we put on it, and how much will they make next year? And as we're learning today, Cisco and Walmart, two of the positions that I own, are not anticipating making as much next year as I had as I had hoped. But the good thing about a lot of these stocks that haven't moved is that they've got inherent multiple compression because we're not buying them. Like, we don't care at all. There's no bid, and they're still increasing their earnings.
Isn't that a good thing?
Eventually, it will be.
If you're a long-term investor, it's great, but you have to wait for it to matter.
So you have to have a long-term horizon, lots of patience, and if you run a strategy like I do, and you're sitting there 2 years where we were down 1.5 last year, we're up 1.5 this year, we've made nothing for 2 years, which I'm proud of. I think it's great because I think the average stocks are probably down like 6% outside of the really hot names over that 2-year period. But the idea of rate cuts in combination possibly with a soft landing, it's awesome for me because then all these stocks increase for 3 reasons: the multiple, the earnings, and really just maturing into the.
It's like a coiled spring.
Exactly.
If somebody told you 2 years ago that the Fed was going to drop 500 plus basis points of rate hikes and that you were going to be flat or the market was going to digest it fairly well, would you have taken that? Absolutely,
100%.
Right? Yeah.
But we live on a Gregorian calendar. So as brilliant as I was last year, this is 2023, and I don't have any of these great high flyers in a dividend portfolio.
Did we buy too much cash as an investor class? 5.6 trillion record into money market funds.
I love what
year.
you put in the doc. Shit, did we all buy too much cash?
Did we all all buy too much? So judging by this week, if we're going to start getting a string of benign CPI reports, in my imagination, like we're going to continue to see yield curve, normalization.
Yeah.
All right. So then all of a sudden you have overnight rates are not going to hold up here for much longer. And if you didn't lock in the higher, longer term rate, you're losing that opportunity. So what do you like? Does this money go back into stocks, I guess, is the question.
At much higher levels.
At higher levels.
Yeah, much higher. We're not going to get out of the money market until things get better in the stock market. Why would we? We're getting 5% in the money market.
Yeah.
We don't realize that that's the first to go down. That before we know it, it'll be 3%.
It'll be 3. Yeah.
And you have inflation, which is anywhere between 2 or 3% that you've got to factor into that real return. But even if you're getting 1%, that's still way better than 0 that we were getting for 14 years. So it feels really good. But the problem is we won't get back into the markets until it's better.
Yeah.
But I think there's a
you
3
say
to
we,
6.
like colloquially, like
Yes.
we,
The
the investor
royal
class.
Left to our own devices, any of us.
Well, but
Yes.
think
Yeah,
about how slow money was to move. Rates went to 1% to 2% to 3%. They really didn't. The money markets didn't really start to hoover up assets until really March when SVB happened, and then by then rates were already 4%. It's going to be the same thing in reverse. Rates are going to be
You sure
5.
you sure about that?
I am sure about that.
Okay. I don't know. Maybe. None of us have seen anything like this before.
I don't think that money is going. I think that it was slow to come in. It's going to be slow to move out.
Can I show you some charts?
What do you think
Please.
about that?
I agree with that.
Okay.
And I don't think that's a mistake.
Of course.
Lock in the 3 to 7 year.
Yeah.
Go into the stock
Yes.
market
All right.
now.
Yes.
This is total money market fund assets. And as you can and this goes back to 2007. So as you can see, there are twice as many dollars in money market funds assets than there were after 2009 when the stock market bottomed. Because remember, that's the last great chase into money market funds on the heels of the great financial crisis. And I was a retail broker then. Every phone call inbound was sell whatever I have, just leave it in cash. We'll talk about it later. And of course, we didn't talk about it later.
But if you divide money market funds by the size of the S&P 500,
it's smaller.
It's much smaller.
Okay. Institutional investor cash allocation. This is not as extreme. I wonder why that is. So you can see that there's a lot of cash being held by institutions, not as much as there was in the immediate aftermath of the pandemic, and nowhere near as much as there was during the heart of the financial crisis in 08. It looks like...
Well, that plus the post.com era.
Correct.
Hang on a second. This is still ludicrously high.
No, it's 23%, 22% institutional investor cash allocation.
Is this for real?
Well, State Street said it, and it's in the Wall Street Journal. I didn't make it up. It's high. It's good. This is fuel for the fire.
Yeah, no, but looking at this chart, it's almost always high. This is crazy. What
do you think I don't know what institutions these are.
What do you think the average here, just eyeballing this? It looks like it's at least in the teens, maybe in the 20s?
14, 15.
But institutional investors, it's not a retirement portfolio for one person. They have ongoing liabilities they have to fund. That's what makes them institutions. So it's not always a market call.
All right, so then maybe this chart is not relevant. What is I would be more curious to see the fund manager survey. What does that look like?
Next chart, please. That's not this.
That would have been awesome if it was.
I was about to be very
Cumulative
impressed.
returns from July 1981 through September 2023. This is also the Wall Street Journal and Vanguard data. And what they're telling you is, hey, asshole, you probably feel great that you're in the Vanguard Federal Money Market Fund right this minute. But here's what happens over the long term. S&P 500 returns, even the Bloomberg aggregate, U.S. aggregate bond index, Barclays, let me read this. The Vanguard Fund has returned an average of 3.9% a year. That's a cumulative 402% through the end of September.
Nominal.
That's over 40 years, guys. The S&P rose 8.6% a year, which is 3,200% over the same period. Even the aggregate bond did 6.8% annually, or 1,500% in total. So your money market return is great right now. It is not going to be competitive with stocks and bonds over 40 years.
I wanted to ask you, how's your battle of Sherry going about your SHY now that you have to come down?
I look smarter this week. She doesn't know what the money market rate is because in a Fidelity account, it doesn't say it next to the holding. So she still thinks she's getting 5.5%. I'm going to let her think that. I will eventually explain this properly.
All right, so last week, it was CPI day. We had an incredible day. It was Tuesday. That's this week, right? Was that what happened on Tuesday? I don't know.
It was Tuesday.
It was Tuesday? Okay. So on Tuesday, basically every stock was up.
Yes.
Right? I think 92% of the S&P 500 was up. So there's some Bank of America. The New York Stock Exchange, they showed what happens following a day when 90% of the issues were up. And there's 86 prior observations. So
they go down every day after?
No, it's bullish.
For the rest of your life, they could be a drop.
As JC would say, an overwhelming amount of demand for stocks is not bearish. So they show the average return 10, 20, 30, 65 days later. And the average return is not necessarily the important part, although 30 days later, it's 3% average, 5.3%, 65 days later. The important thing is that it's higher 75% of the time 30 days later and 81% of the time 65 days later. That is I don't know how often stocks are positive on a 30-day basis. I'm going to guess it's, 60%?
51. Is 51.49.
No, because it's 50-50 on a daily basis. So let's just say it's 60%, whatever. Point is, this is bullish. When there is an overwhelming amount of demand for stocks, that historically is bullish on a go-forward basis.
What are your thoughts?
I'm a long-term investor. I invest by company, but I think it's super cool to look at this stuff.
There we go.
I would have thought every day it would be down after the big surges. But if you think about the psychology, because momentum can carry a market.
That's exactly right.
If we get a year-end rally, it's going to be more sentiment and momentum and positioning. You talk all the time about window dressing. You want these portfolio managers to show, look what we have.
I did that today and people got upset.
Well, it's so stupid because look at their performance. It doesn't matter what you have at the end of the year.
The concept is the dumbest thing ever.
It's
not
idiotic.
window dressing, but chasing is real.
Yeah,
It's chasing.
that's 100%.
Yeah.
So
Yeah, window dressing is super dumb. It's like, yes, I was down 10%,
But
look,
now I own
on the
NVIDIA.
last day of the quarter, I put on a 5% position.
But at least
in
I
NVIDIA.
chased NVIDIA.
At least I tried.
yeah, the year's not over. I could still do it. But if it doesn't pay a dividend, I can't own it. My dad called the other day. He's like, why don't you have NVIDIA? My dad lives in the Poconos.
It
I don't
does
think he
pay
has the.
dividends.
I don't
How
think,
about that? They just instituted it.
I saw
does,
it was
it
like
does.
it was like a rounding error to
Well,
me.
they're trying to get into your fund.
It's not going to make it into your fund for 10 years, but it's
I wish
it's a nominal.
I wish it was a little bit more. We could. I think it's a great company. But so the point is, my dad doesn't have the internet. He doesn't. I don't. And certainly doesn't know what NVIDIA is, as far as I can tell. But hey, how come we don't have that?
Yeah. How come we don't have that stock that everyone on TV has been talking about every day for a
I've
year?
never heard of it.
Right.
Let's talk earnings.
Yes, let's. Earnings season had a little something for everyone. I think for the Bulls, obviously, we had a higher beat rate than normal, which we seem to always have. I don't know how that works exactly. But for the Bears, there were some pretty high-profile disappointments. Or,
Forecast.
yeah, I was going to say
disappointments.
good earnings and poor forecasts, which led to post-earnings sell-offs. What do you think's going on here?
Well, we know that we lower the bar every earnings season so we can beat it, so we can have these 80, 90% beat numbers,
Shh, don't,
which is always great.
we don't reveal that.
Top and bottom line.
Yeah.
So we were talking earlier about Cisco and Walmart, two stocks that I have painfully today. They both crushed it top line. They crushed it bottom line. Everything was great on the quarter. But who cares what they did last quarter? What matters is what are they doing next? And when
Yeah.
you look at the sales down, the profit margins down, they're talking about the consumer tightening their belt a little bit. What I care about is what the CEOs are saying is coming next. And in both of those scenarios, it lends itself maybe into that recession camp, possibly. But it hurts the stocks. So our earnings season, I think, was good. It was a pleasant surprise. It was better than feared, but it didn't do anything for unless you crushed it and then you had great forecasts. You still couldn't catch it.
I saw like Walmart, Home Depot had good earnings. Guidance wasn't great. They hit the stock not unmercifully.
No, the stock went up quite a bit because so their earnings were okay.
On big ticket items, I was saying, that's the recession signal to me, is when the longer people are putting off those bigger purchases.
And the larger renovations, the
Yeah.
more expensive home renos
yeah.
is down.
But we also did that.
Yeah.
But maybe if interest rates come down a little bit, it could tap into a HELOC. Maybe they're not going to move because you've got a 3% mortgage rate. But if you get a 6% HELOC, then you can start doing home renovations.
Oh, if
again.
interest rates come down, big ticket items are going to explode.
Yeah.
Yeah, there's a lot of people waiting.
And everybody bought refrigerators and appliances.
Right, I'm
during
saying
the
you already
pandemic.
did that.
Yeah.
If you so there's a great chart from Barclays showing after 12 months of middling results, the third quarter finally delivered a quarter of above average earnings quality. So the chart on the screen shows that the third quarter saw a major improvement in our earnings quality indicator with earnings surprise and 3-month revisions into the print coming in above long-term average.
What does this mean?
The 3-month revision is a little bit less bad from the first quarter to the fourth quarter, a little bit less bad from the second quarter to the first quarter, and a lot less bad from the most recent quarter to the prior quarter. A lot less bad.
So that you're saying the revisions are coming in less bad, or more of them are positive than negative?
Correct.
Okay. What's earnings quality in this context? What are they? That's all they're looking at all they're looking at is guidance.
I don't know what's in the quality bucket.
Okay. All right.
But year-over-year growth, it's been negative.
Well, you have to start somewhere.
It's been negative for three straight quarters. We just spoke about the earnings recession is over. Pretty positive earnings growth this quarter.
So for the full second quarter, like the S&P average earnings were down 6%. It's a negative year-over-year 6%. We were all celebrating because it was better than feared.
Right. It was supposed to be down 9 or
Yeah,
something.
so it was awesome.
Yeah,
It's great. Aristocrats and like a little like asterisks. Most of the average aristocrats were up 10% year over year in the second quarter. Their stocks don't go up. Nobody buys them, but they had profitable quarters. So we'll see what happens this quarter kind of on a comparative basis. But what I think a lot of people are getting excited about is the prospects of actual earnings growth now heading into 2024. The further we get away from the pandemic, the easier it is because you've got poorer numbers to reflect against it. Just like they
had
lowered the
negative
numbers.
earnings in the first half of this year. Those are great comps for the first half of 2024. It's
Exactly.
rare. You don't see that
Exactly.
a lot.
Yeah.
So now we're getting earnings growth and margin expansion. So according to FactSet, the net profit margin for the S&P is on track to come in at 12.1% for Q3, up from 11.6% in the previous quarter. That's not nothing.
No, it's awesome.
What are these other
All right, so
earnings charts?
this is from Belsky. We're looking at the aggregate EPS surprise, and on a quarterly basis, at 7.6%.
That's the average surprise is 7.6% better than expected.
relative to what they were expecting.
That sounds pretty
So
great.
the pre-pandemic 10-year average is 6%. So pretty darn good. And then the percentage
Hold on. In the fourth quarter, it was 1%.
nobody was beating.
Right. So it's pretty good. Okay. What's
And
the next
then the percentage of companies that are beating is also higher than the last 10 years. It looks like averages, I don't know, 70% or so.
one?
And we're around
now
like
it's 80.
It's
80
probably
plus
100.
%.
I mean, sorry.
pretty good.
Let's hit 100, and then I'll feel safe to sell my money market fund and get back into stocks when everyone's beating. What's the guidance trend chart?
Oh, this one.
Let's
Oh,
get this
how
one.
good is this? All right. So remember how bad the fourth quarter was?
Yes.
Like everybody was guiding lower.
Yes.
And so they were guiding lower. Analysts were lowering their estimates. And of course, lower the bar, get over the bar, raise the bar. And so now we're at that part of the cycle. The percentage of positive outlooks relative to overall outlooks is around 40%, going back to 2000. This is from Brian Belsky at BMO Capital. And for the most recent quarter, it was roughly, 45%.
Yeah. So we're above average in terms of the number of positive
But
outlooks.
more important than like just the number today, look at the washout. We already did it. Like the S&P 500, we spoke about this last week. They already braced for impact. They
Yeah.
already did the cost cutting. They did what they had to do to prepare for a recession that never came. And a lot of that explains not just the 7 stocks that drove the rally, but a lot of that is the reason why stocks are doing what they did this year.
Well, because we were going to have a recession in 2023,
And we didn't.
and we were going to have rate cuts at the end of 2023.
Yeah, but
offset
I
the
also
recession.
think big revisions in tech companies very, very hard to have foreseen a year ago. Like when we were in the fourth quarter of last year, there was not one technology company that had anything upbeat to say. The venture guys were on Twitter crying.
Cloud growth was slowing.
Everybody was firing employees. Meta was in this like massive reset. Like it looked like Meta was completely going down the tubes.
and didn't YouTube have a bad quarter or two?
Everyone.
Yeah.
So, but the point is, like one of the big things that bailed out the market this year. Like if you ask me, what's the story of 2023 for investors? What are the takeaways? You had really big technology companies and consumer discretionary communications that kind of saved the stock market.
Oh, yeah.
Like they're really big, they're really important in the indices, and they were able to somehow grow earnings while cutting costs. This is like almost like very difficult, like flat revenue growth, cut costs, grow earnings. It's pretty remarkable.
It was like Coca-Cola that came out where they had you have a little bit of shrinkage.
Yeah,
You have a little bit lower margins.
Yeah.
You increase your sales and you
Yeah.
increase your overall revenues.
yeah. So that was kind of miraculous. I don't think a lot of people would have
Coca-Cola didn't
guessed
go
that
up
we
200% though, like
No.
NVIDIA. So
No.
Can I just
maybe it's
speaking of-
not the same.
We're about to show a chart of the Magnificent Seven versus the rest of big tech and the S&P, but it's not just big tech. 80 stocks in the S&P are up more than 20% this year.
that's awesome.
80.
All different sectors too.
Yeah. Now, there's a ton of stocks in the S&P that got the shit kicked out of them, but it's not just 7 stocks that are doing all the
Well, I think that's the important thing of a broadening out of the market. It's got to start somewhere. So where you had such a narrow single digit, now you're close to 100. It's what we need to see, what I certainly would like to see based in my world. But it makes for a healthier bull market, not just a little isolated piece.
But do you think that your world are of these dividend payers, those are income generating assets that are used for people that are looking for income. And when cash is giving what it is and when bonds are giving what they are, clearly those stocks become relatively less attractive. Maybe not the businesses, but the
Temporarily.
stocks.
No, they do,
temporarily.
100%.
Yeah,
Because
yeah.
if you can get that 5.5% in the money market, what do you want 3% from me for in dividends? But the reason is that our dividend growth over a 5-year period is about a 10% increase on the dividends. And that's your hedge against inflation. But you can't see that on a chart.
Yeah. And right. And it's a total return situation too.
Yeah.
Put up this chart from Barclays, Daniel. It's fiscal year 2024. This is showing earnings revisions since the start of earnings season. Michael, we talked about this on Tuesday,
It's
right?
such a great chart.
This is a great chart. So the dark blue line is big tech. Turquoise is rest of S&P, and then green is the rest of tech. So even within technology, there's something really special about these stocks, and they were a big part of why the market looks like it's going to finish positive this year.
Did Apple revise up?
I don't know if they revised up. I think they might have affirmed.
Yeah, I think. Yeah.
Yeah. But that stock's hitting 190 right now. Like,
I would sell it.
Well,
I'm gone.
you're selling it back to them if you sell it,
I know,
or to
I
Warren
know,
Buffett.
I know.
Let's do this earnings recovery chart. I love this thing. So is this surprising to you when you see this? When you see this setup like this, Kevin, is this surprising to you? This is basically earnings typically recover stronger than they fall. So this is the story of why invest in stocks even when earnings are falling.
capitalism.
This is capitalism.
This is corporate America, baby. We're really good at this.
Like you have earnings fall off in a recession or a bear market or both, but when they come back much stronger. And this is a count of how many quarters
Every time.
along the bottom. So it's first of all, it's every time.
Except for that one time.
We weren't alive then.
We don't have to worry about that.
I was looking for 2000, 07, 08, and 2020. They all make me feel good.
Yeah. So I think that's like the wise stocks versus I could just buy money markets.
I would never not be in stocks, no matter what happens. Even over this past 2-year period.
Could you preach a little why?
Again, you have the erosion of capital based on inflation. Because even if we get inflation back to 2% like the Fed wants, and you're in a 3% money market, it's just a 1% return. You don't have any opportunity for total return. You don't have any opportunity for increasing cash flow. And to Josh's point, if you think of dividend-paying stocks or dividend growth more specifically, if they're good companies that make money and continue to have profitable businesses, their share price will grow. And then you've got a distribution on a larger corpus. It's just impossible unless you have so much money where it doesn't matter, that to not be in stocks and to be in money market, it never works. It never works.
I think what you're saying is number go up. Like I think that's like right. Yeah. Like that's in the end, you might have to wait a little while, but
I mean, if we think about the stock market as a collection of businesses, which is what the stock market is, especially individual stocks, as a hedge against inflation, I mean, I saw like Pepsi, for example, where the number of items that they were selling was, up 0.5% or whatever, but the total volume or the total revenue was up 11.5%.
Yeah,
or whatever the numbers are. They're able to push it through to consumers. That's the whole deal.
That's what inflation is. So I think if you own Pepsi for the past 10 years, I'm not 100% on this, but it's probably like a 9% annualized total return when you factor in the dividend.
Yeah.
Because we looked at a chart earlier, it was 8.6% on the S&P since 1981. Since 1926, it's 10.2. And I think the most important statistic in there that we never really talk about is that of that return. So if you go back to 1926, almost 100 years, 10.2% return on the S&P 500 is awesome. 39% of that return is dividends and distributions reinvested.
Wow.
That's why you're in stocks. And since the 87 crash, which is more our contemporary time period, it's 50%.
Wow.
And that's S&P Dow data. You can look at it anywhere. It's not
the traders aren't getting that. The investors.
No, it's the investor. But that's how you have true wealth creation.
Yeah.
And I don't have stress. I mean, I'm complaining about some earnings today. And
But Kevin, what if you're just looking to have fun?
I don't have any fun.
I'm
an old man. What do you have fun for?
Can we talk small caps? Is this an important part of what you do or not at all?
Anything that I say about small caps will be me making it up or talking just like your retail clients.
We'll skip that. Small caps are cheap. Does that tempt you at all as an investor?
I think
there's
if
an opportunity there.
So it won't be for me because I don't style drift. I have this very unique defined lane that I live in. But anytime, even with the chart that you were showing before, when you have things that are relatively out of favor for that long, there's probably opportunity there. Because the problem with small caps is that they oftentimes have to be dependent upon capital markets.
Yeah.
So when you have zero interest rates, it's super great to be private companies and small
Although
cap.
it didn't help them much relative to FANG stocks.
No.
Like we had zero interest rates for a long time and small caps lagged. So it didn't work on the way up this last time.
I'm speaking as a retail investor. So if you tell me that,
you can take my word for it.
I believe you.
So can we show the chart of the S&P 500 multiple versus the equal weight multiple? This has to get you excited, Kevin. So
it depresses me because I'm more like the equally weighted.
You look more like the equal
But the S&P is trading at 18 times
mean reversion coming.
expected earnings for next year. But the equal weighted version is just trading at 14 times, which is probably appropriate given where interest rates are. Nevertheless, does this excite you or whatever?
It does, because if you think of me like the tortoise versus the hare, or just that chart versus the tortoise versus the hare, over time you tend to get to the same place. There is a true revision to the mean, as long as you've got quality companies that aren't just non-profitable businesses. And if you can get there with lower volatility, that's how we try to satisfy our clients. But I like seeing a 14. I don't even think the 18's scary when you talk about the weight that's involved with those mega tech stocks. Like that's even too cheap. So if you have interest rates come down, that number can go to 20. So it's never a question of me versus these growth stocks. You have to own them. You have to pair me up with those growth names because people will always pay up for growth, especially in this world where technology is so important, AI is so important. It's not like the dot-coms. It's not a scam. It's not some fake thing. It's not meme stocks. Like these are game-changing businesses. And I think that that it's going to be so exciting to watch and see what they do. And I'll bet a bunch of them, even though they may be up 100, 200%, they're probably undervalued based on what they're going to do over the next 3 years.
Are any of the names, like is Microsoft in your portfolio?
We do own Microsoft, thank goodness.
Okay.
We've owned it for 11 years. We've never sold it.
Right.
We trim it because we've got position sizing. I do own Apple, and I am going to get it called away. So when I said I'm selling it, like it's getting called. I have no choice. But this will be the 9th time in 11 years that I've been out of Apple in its entirety. So I'm going to have zero Apple.
Can we talk portfolio construction on enhanced dividend income portfolio? So that's your flagship, right?
Yeah, that's like 90% of our assets are in there. And it's 25 to 30 stocks.
Well, hold on. The universe is what? The S&P?
Primarily the S&P 100.
S&P
Yeah,
100.
yeah. I do own CME, which is
All right, so
outside
you are
of it.
skewing large
Yeah, it's-
relative to even the S&P.
Yeah, I want the biggest, best of breed, just cash on cash. Because if you go through periods of economic depression, I just want them to
Okay,
just want
so each
tons of
holding
cash
each
flow.
holding is roughly 4%?
It's going to be anywhere between 2 to 5. 5 is the maximum.
Okay, and that's how far will you let that drift? Is that a
7 to 8%, we'll trim it back. It won't get to 8.
okay?
So with
Is that
Microsoft this year,
opportunistic or is that on a calendar?
it's just real time.
Oh, in real time.
Yeah.
Okay.
So we don't do anything else. So we don't worry about where it's a quarterly rebalancing or an annual rebalancing. It's just everything is daily, pretty much daily.
How many of those 25 to 30 names will you have covered calls sold against at any one time?
Historically, it's been 30 to 60%.
Okay.
But the VIX, and you talk about this every day. I mean,
Yeah.
the VIX has just been so muted.
So does that mean there's no juice for you?
Not enough.
Yeah.
Not
Especially on the like what I would
The
term more
volatility
boring
premium
stocks.
is not there.
Yeah, and even less on these S&P 100 names.
Yeah.
So, the good thing about covered call rating is when you get excess vol, like 08, we crushed it. 2020, we crushed it because the VIX went up into the 80s. Usually there's an inverse relationship. Historically, there had been an inverse relationship between volatility and market performance. 2022 was the exception that proved the rule. We were
that's
down
right.
20, 30%,
And
the
low vol.
VIX never did
Yeah,
anything.
yeah.
Because there was no
That was-
surprise.
We had Bob Pisani on, and we were talking about that. Like, where is the VIX? And he had a really good explanation about the time window that the VIX measures.
30 days.
Yeah, so when you're at a 25 VIX, that the market is looking for something really extraordinary, not only to happen in the future, but like now.
In 30 days.
Right. And that you really need to have substantial stress to get a VIX materially higher than 25.
Exactly. So think about those two occasions where it went. And 2000 was good too because we had a dot-com bubble. But
Yeah.
that was that wasn't quite as extreme in terms of call rating. Maybe it was, but you weren't expecting a financial crisis in 08, and no one was hedged against it. So the institutions didn't have their portfolios hedged.
Do you think everyone's hedged against everything now?
Yeah, that's why I think that's why the VIX is so muted. And there's not, and maybe they're not, and they're not. A smart money knows that when you go from 0 to 500 basis points of interest rates, things aren't going to go up. So I don't think they were leveraged or putting their neck out to try to make a whole lot of money, and you didn't get caught off guard.
Therefore, they're less sensitive to volatility because they're just not as heavily exposed.
I think so because you didn't
That's
plan for a pandemic.
Positioning. It's always everything's positioning. Wait, so I wanted to ask you. So how far out of the money are you going on covered? If you're not, so you're not getting the same juice that you used to, but you're still getting a nice benefit from the covered call. You're protecting your downside. You're bringing in income currently.
Yep. I believe in very short-term covered call writing, some 30 days or less.
Why?
Out of the money. I tend to think I invest in good companies that go up, and I have more control to keep the position with a shorter
So
option.
you don't want to get called away if you could help it.
Almost never want it to get called away.
That's interesting. You'd rather roll the option and keep going.
90% of the time I would.
Okay.
Now, when I was taught this business was over 30 years ago, and they would be like, the mentors and the people that taught me the business would define everything on option premium. How much premium can you generate?
Okay.
And everything had to be a round lot. Everything that had to have a covered call written against it.
Yeah.
And that's how it would define success. It had nothing to do with total return.
Yeah.
And I would be like, well, the client doesn't give a shit about the option
And
premium.
then you're turning equities into bonds.
Yeah, they start with this exactly, and they want
Yeah,
this.
right.
You can get
It's
a convertible.
It's alchemy. It's right.
You can have a convertible bond with less downside risk in the equity
Yeah,
markets.
yeah.
But they would just tell me to shut up and go away. And then I would say, well, look, if we're so smart, if we're so good at trading options, I mean, couldn't just between us, is every single environment, every single day, a great time to write a covered call on every stock in every sector?
No.
Of course not. But they're like, again, just shut up and go away.
Yeah.
So I thought, and then plus all their good stocks would get called away. They'd be left with this shit. And they were just bad money managers. And they were stubborn. But that's how they were trained to do it. And that's how I was trained to do it. And I thought, well, that's idiotic. So why not just make the portfolio the main piece of the puzzle? The dividends are far more important than the option premiums, and use it when there's volatility. And we'll get covered calls on 10 names. That's it.
So more opportunistic. Like, oh, look at the premium there. Let's take it now.
Assuming that certain things happen. So
But can you be opportunistic in the ETF, or you don't have that flexibility?
I run
do
the
you?
ETF exactly the same way as I run the strategy.
Okay.
That we don't think of it differently.
So today, as an example, so Cisco and Walmart, I assume there's going to be long-term holdings for you.
Yep.
They both have like a mini blow up after earnings, but fundamentally, there's nothing wrong with these stocks. Is today the day that you're out there looking for that premium to sell, or
So I probably won't do any. We won't sell today because they're down.
yeah?
But the vol spikes.
Well, that's
so
what I
it's
mean.
neat to look at. So every
Yeah,
day
yeah.
we look at every position. We go 30 days out, 5% up.
Okay.
What's the call premium? And if you can get 2 or 3% annualized, which isn't much, then we'll think about it. If it's less than 2.5 or 3%, which has been the case more times than it hasn't because there's been low VIX, then we just don't write a call.
Are your shareholders judging you on the income generated, or they're smart enough to look at total return? Like what do you like? Does anybody sit
the
with you and
advisors
say,
we work with are incredibly smart.
Yeah, yeah.
Obviously, they're smart and looking for total return.
Okay.
Their clients.
Because I wanted to ask you the breakdown in tax treatment between the income that you're generating on covered calls versus equity dividend, because they're treated differently.
Exactly. So the dividends are usually qualified.
Yes.
So that's kind of on the good side.
Yes.
Because we write short-term options, 30 days or less, they're all ordinary income, the highest
So you're not
possible
doing real
tax.
estate investment trust distributions. You're
No.
doing equity dividend. That's why they're qualified.
Right.
Okay.
I don't have any REITs, but
Got it.
but the option premiums, I mean, those are the highest tax bracket.
Yes.
And we're doing 30-day calls. But when I look at it, I say, well, our dividends are 2 to 3%. It's qualified.
Yeah.
Our option premiums are really only 2, 3, maybe 4%.
So blend it.
It's the same.
You blend it. It's the same. Got
I
it.
don't think that's compliant.
No, I
But I'm
understand.
saying
but
in my brain,
it's-
that's how I think about it.
the net impact tax wise to the client works. It comes out in the wash.
In years like 2017, 19, 20, 13 even, like we were up over 20% those years.
Yeah.
I had more turnover than a buy and hold manager because I had things called away. And there's not many losses.
But in that type of year,
really
nobody's
hard.
mad at you for being up only
No.
22%.
Well, I have an uncle that gets pissed if he has to pay anything.
Yeah,
like
yeah,
if you, it's like the idea of making money and paying taxes is sacrilege. You'd lose money any day of the week before he had to do that. But high net worth, like the advisors, the advisors and the
Well, you
clients.
deal with
work
wealth management guys and gals. They know what they're talking about.
Yeah, they
They're
know where to
talking
place.
educated people.
We only work through financial advisors, and more than half of our business is non-qualified,
Okay.
which I think even still surprises me.
Why?
Because in a covered call strategy, in a qualified account, you don't even have to worry about the tax implications.
Like in
at all.
an IRA, nobody cares what the taxes are because
Right.
they're not paying it.
So in the old days, we were almost always plugged into IRAs.
So that's my point. Like this is more suitable probably for that.
If all things were equal, I would agree with that. But so many people just
They don't have that.
they don't have it in the IRA, and they need money and they need rising income. So we're not tax efficient by any means, but we are tax aware. And the advisors we work with can do tax loss harvesting with us, all year round. We don't have to wait till the very last day of the year to do tax loss harvesting.
You're an SMA.
Yeah. Until this year, I never had a loss. So I don't know that it mattered. But
Right, but the difference between that and the ETF wrapper is that you can figure the tax consequences out during the year, and you can be advantageous.
yeah, I think ETFs in general have some kind of smoke and mirror tax efficiency.
Yeah.
Again, probably not the compliant way to say it, but a better way could be that exchange traded funds were designed to be somewhat more tax efficient
Then
than
a
40
mutual
Act
fund.
funds.
Then a mutual.
You ever
fund.
have an advisor call you and say, "Listen, I like your strategy, but get rid of the Cisco."
Not
just Cisco
probably
specifically, but-
today. I think if I turn my phone on, it's probably 100.
But just any specific stock.
It used to happen with Nike all the time.
Nike.
Yeah,
Yeah.
why do you own this? Oh, because they're woke.
Yeah,
Yeah,
it was
I
with
can
Nike.
imagine
We would get it. We just bought Cisco. Like this is a new position. I think we have like 2%, but of course we bought it right before today. We did the same thing with Caterpillar, but it was a 1% position. We're just kind of initiating things, and it takes us a long time to get into it. I think I'll have to sit down and really dig into the Cisco position, but I'm probably not going to bail on it. Jim Liebenthal texted me last night. He's like, "Oh, this happens all the time with Cisco. I should buy
Yeah.
more." I said,
Yeah.
"You didn't read the report."
Yeah.
But it's just he's owned it forever.
Shout to Jimmy. Hey, I want to ask you about Warren Buffett. You a fan? Acolyte fan?
I come
Detractor?
from. I'm not a detractor. I
Okay.
come from the same school of thought from Benjamin Graham. So everything that I do is Graham-esque, I think.
Like it's grounded in valuation.
Yeah.
Okay.
And even my portfolio construction size is from the Intelligent Investor, a 30 position. Because everyone's like, why do you only have 30 stocks? I'm like, well, Ben Graham said that's good, the ideal position. He's smarter than me.
Yeah,
and
you know more than Ben Graham.
That's what I say. Start fights and alleys, and people are
Right.
like, who the hell's Ben Graham?
Yeah.
But
Okay.
so I like Warren Buffett. You own Berkshire. I don't, but I'm a fan of Warren Buffett.
We got 13F from Berkshire Hathaway last night. So they sold off the rest of their General Motors. I looked that stock up today. I haven't been following it.
Yuck.
That is some piece of shit. That stock is now at 2014 prices.
Wow.
They've actually grown earnings since then.
You're kidding.
Yeah, like Mary Barra. I don't know what Mary Barra has like a hold over like the board. They must think she's like just this amazing person.
This is truly
Because
disgusting.
this is one of the worst
stock.
charts.
Well, they signed a nice contract. I'm sure that.
With what? With the UAW?
I was just kidding.
Yeah.
Because it's
Well, that
doesn't
ain't going to help anybody. All right. Anyway, what else did he do? Oh, he has a mystery stock.
What does that mean?
Okay, I'll explain. This is Barron's. Berkshire disclosed in its recent 10Q that its holdings in financial stocks went up by $1.2 billion in the quarter, and no additions to its existing financial stocks were disclosed in the new 13F, meaning they didn't buy more of the financials that they already held.
All right, can
So
I take a
there's a
guess?
new billion-dollar position. Do we think it's SoFi?
It's Coinbase.
It's Coinbase.
Is Robinhood still
right.
in that category?
It's Robinhood. All right. Berkshire occasionally requests confidentiality when Berkshire accumulates stocks and doesn't want to tip off the markets because they're not done. Berkshire did so in late 2020 when they were accumulating Chevron and Verizon.
Real talk. My guess is Goldman.
That's actually a really good
Like,
guess.
just he loves those durable brands, and everybody hates Goldman.
And
right
it's been
now.
down a lot.
yeah.
And I like that. What do you think?
Does he still have the positions that he bought in 2009? Remember, he had a lot of.
No,
Okay.
he's been all
think so.
out of that stuff for a long time. Bank of America, he's been out of that stuff.
Well, then it's only. Just a guess. It's either J.P. Morgan or Goldman.
I think those are good guesses. I like it. It's notable that Buffett is requesting confidentiality on what is a small holding, probably around $1 billion, against a total equity portfolio of $350 billion.
Well, maybe it is Robinhood.
Maybe it's Robinhood after all.
Did you see Bethany McLean wrote an article, R.I.P. Goldman Sachs?
I didn't read it yet.
Oh,
Who's she write that for? Business Insider?
Yeah.
Is she writing for BI now? Okay. What else did they do? They bought shares in the Braves. They think that's Todd and Ted, and maybe they didn't buy it, but it was some kind of a spinoff from Liberty. And then they have a position now in Sirius XM.
I thought that
Which
was.
have you looked at that stock lately?
What's the ticker?
Holy shit.
SIRI? That's what
Yeah.
it used to be.
It's now a $19 billion market cap. There's like an arbitrage thing going on here with
Stock doesn't move.
there's a John Malone tracking stock that trades at a discount, and this thing trades at a premium to the, I don't know.
I don't get it.
It's all
Sounds fugazi.
bizarre. What else?
It's a wazi, it's a woozy.
Oh, here's the point. Here's what I wanted to ask you, Kevin. So Berkshire sold $7 billion worth of stock in Q3 and only bought $1.7 billion. So they are a net seller last quarter and in the first 9 months of the year. They're a net seller of $23 billion worth of stock. In the first 9 months of 2022, by comparison, they were a net buyer of $49 billion. So this is a big sea change in their equity ownership relative to their own portfolio. They have $157 billion in cash. Are they like sitting in money market funds like everyone else?
I was going to ask you, are they buying back their own shares?
Well, a tiny amount, 1.1 billion, nothing.
Because that would have been my guess.
Tiny. 1.1 billion. The stock's at an all-time high. But they're like not that different from everyone else.
Well,
They're sitting in money markets. They're collecting 5% on $157 billion. Like, why take risk? It's Berkshire Hathaway, baby.
I don't know what that percentage is in his overall portfolio.
157 billion versus 350 billion in stocks. So it's like a third of the portfolio.
That goes back to the institutional chart where they had 30% in cash.
Yeah.
Well, maybe he's seeing a recession coming in 2024. Maybe he has an acquisition in mind.
Yeah. One last ride. One
It's better to make 5% cash when you have that much versus 1%.
Yeah. I would agree. Did you have fun on the show today?
It was awesome.
Yes.
I can't thank you guys enough.
All right. We're
Great.
so glad you came.
Yeah, I don't know if that's true, but I'll bring it next time with a little more energy.
I want to hit you with one more thing, though, while you're here. I got a serious problem with this. Joe Biden went to California to meet with Emperor Xi Jinping. And first he called him a dictator at a press conference, which is really smart. His advisor winced at that remark.
Wait, what did he say?
He called him a dictator.
How so? Like, in what context?
He
Well,
didn't
he
do it
wasn't
again.
like, look at this f***ing dictator, but like he literally said the word dictator from a podium. Like,
Wasn't that a long time? Wasn't that like several weeks
no, it was
ago?
yesterday.
He did it again?
He did it again. He's a gaffe machine. That's why this guy's not fit to be the president. He doesn't even know how to trick everyone else into like not knowing what he thinks.
I could have faked it through the small caps.
They
even though
had
I
a
didn't know
dinner.
anything.
They had a dinner for tech execs who are basically like reliant and terrified of China at the same time. Like Elon Musk, Tim Cook, they all need China to make and sell things, but like they also can't lean too heavily into the Chinese relationship because the optics here wouldn't be great. That's a tough situation. But here's what I wanted to ask you: what's your thoughts on pandas?
Are they really going to take the pandas back?
No. They're offering to give us new pandas. And I'm like, get the fucking pandas out of here.
Why can't we have the pandas that we have here?
Oh, so here's the problem. They're on lease. They're on 50-year leases, these pandas. And then you have to give them back. The zoo,
Wait, how long do the pandas live?
I'm going to share some information
I
with
lived
you.
in Washington, D.C., and we had pandas at the National.
Why do we want, or here's a question, why do we have to have these pandas?
Because they're adorable.
they're
But
really
what
cute.
do they do? They just eat.
They're
We should
like-
give them raccoons. Like here is the North American tree raccoon. All right, listen to this.
I had one in my
I've had
trash
it-
can
I've had it with
yesterday. We
this.
could have brought it.
China could send new pandas to the United States, calling them envoys of friendship, envoys between the Chinese and American people in the latest gesture. Quote, this is Xi. I learned that the San Diego Zoo and the Californians very much look forward to welcoming pandas back. We are ready to continue our cooperation and send back pandas. Well, we don't want the pandas. It's enough already. Nobody really cares that much
Go
about
f yourself, San Diego.
right? And by the way, send them to Vegas. Let's see what happens to the pandas.
What are you talking about?
Like
Vegas?
San Diego. Like make the panda work for it. Send the pandas to Detroit is what I'm saying. Duncan, where should the pandas be sent?
I think they should be out in the wild.
You have the diet of a panda. Do I have that right?
Close.
Mostly bamboo. Okay.
Yeah.
All right.
I saw a thing on the internet the other day where there was a panda in a bucket with a zookeeper. It was really cute.
They're very funny
I feel like
creatures.
kids would enjoy pandas.
Love
Can't we
pandas.
just grow a panda in a test tube or
I like
something?
koalas more.
Same.
That's
We'll
just me.
take unlimited
That's
koalas.
fine. We have good relationships with Australia.
Earlier this month, 3 last remaining pandas at the Smithsonian National Zoo. It's a pair of pandas and their cub were sent back to China, marking the end of more than 50 years of Chinese pandas at the Smithsonian. So that's when this all started in the 70s, right? So apparently we're leasing pandas from China.
I lived there. I went to see the pandas. I didn't know that was the case,
And
and
you
I
lived in DC?
really enjoyed them. Yeah,
All right. Where are you now? You're on the west coast of Florida?
I live in Naples.
Okay. You seeing a lot of New Yorkers and finance people coming down there? Is that what's
To
going on?
Florida in general, but more the East Coast than
Yeah,
the West
they're all going
Coast.
to
For the hedge
Miami.
funds are all on the East Coast, but every money management firm has representation on the West Coast as well. It's a little bit more laid back.
It's more like Midwesterners originally than New Yorkers.
There's this 95 goes to the East Coast and 75 goes to the West Coast.
I'm going to Tampa for Christmas break, taking my wife and kids. I can't get a reservation at Burns
Why not?
Steakhouse. I don't know anybody. Do you know people there?
Well, I don't usually leave a 3-mile radius, but
Okay.
I know some. I'm sure I know someone that
All
does
right.
know someone.
Where should I go in Tampa?
No, you should go to
any
Burns.
suggestions? I should go to
And
Burns.
you need to take your wife to the dessert room upstairs.
And I DM'd them from Instagram where I'm a celebrity.
Right, you are. I mean,
And
I
they didn't
can't
even
believe
res-
it. That
they didn't even
I'm
respond.
surprised it's not being
I'm
comped.
small potatoes in Tampa. All right, we had a blast with you. We end every show with favorites, and we just want to share with the audience anything that you're listening to, reading, watching that you think people should hear about? Michael, you want to go first?
No, I want to go last.
You want to go last? Okay.
So I just finished the Elon Musk biography by Walter Isaacson. I thought it was unbelievable. I didn't know much about Tesla or SpaceX or Elon Musk for that matter until I read the book, and I thought it was an incredible story of whatever you think
Did you
of.
come away from it liking him?
I think there's professional admiration for someone that works that hard and has the drive that he does. So I think it's hard to dislike him as a business person.
Yeah.
The book made him very likable. I think in real life, there's some outside of the book, there's some questionable decisions on social media, but it seemed like there was a lot of positives in his story.
You know what's the irony of Musk? The less you're on Twitter, which he owns, the more you're probably okay with him. Do you agree with that?
Yeah, if you're unaware of what his social media feed looks like, you're probably pretty.
You're like, oh, the car guy.
You're in awe of what he's built.
Yeah, I would agree with that.
So that's all I knew was that he built Tesla, and I thought that was neat. Then I read the story about how he built Tesla and SpaceX and these other companies, and I thought that was really excellent. I mean, he also did it as good. I mean, reading the Steve Jobs book left me with the same kind of like, just you get that insider view. There's no commentary on who he is as a person, but I think everyone should read the book. And then I'm also reading a book about Jack Reacher. I don't know if you guys know who Jack Reacher is.
Ben Carlson
I watched the
loves
show.
Jack Reacher.
Do you watch the show on Amazon?
There's a
Doesn't
second
Ben
one
love Jack
coming out on
Reacher?
December 15th. Yeah.
How many Jack Reacher books have there been? There's like a lot of them, right?
I think this is the 28th book. And
Okay. Do you have to start at 21, or you could just grab a recent one?
This is 28, and I've read the first 20 probably 3 times.
Oh wow!
I just
All right.
keep it on my thing as like
Yeah,
not like a fiction, like a fun thing.
So I do the same thing, but with Bernard Cornwell. I've read all of his books, and there's like 50 of them at this point. But I keep going. I probably read one every year.
It's the same thing.
Yeah,
I mean,
yeah.
And there's a whole bunch of authors like that I really like. And the show I was watching is called Gen V, because you started today's show
Yeah,
with
we
Gen
watched
Z.
We watched The Boys. I didn't watch this yet. Did you watch this?
No, how is it?
If you like The Boys,
Yeah, I
you'll
love The
love
Boys.
it. And you would think that, a spinoff can't be as good as The Boys. It's as good as The Boys.
Who's the spinner?
There are characters that are high school kids that are infected with the V, who are aspiring to become superheroes at a superhero school.
It's like a drug, or it's like a disease. It's like a drug that they
Yeah,
take,
it's a
right?
drug.
Okay.
Yeah, I think that your parents would give you this drug at birth, and then you would inherit some kind of power.
Yeah.
But it's a very dark show, which I know you.
I was going to say, is it as sick and twisted as The Boys?
Yeah.
Okay.
Yeah.
I love that. I love that show. I'm with you on that. A couple of new records came out in the last week. Big hip hop guy.
I'm not a big hip hop guy, but I like all music.
Can I make one hip hop suggestion to you?
Yes, and I'll listen to it.
Meek Mill and Rick Ross, who are two of the best contemporary rappers and have been for the last 10 years. They have an album they put out together. It's an independent, like no big record company or whatever. They're gonna probably have hundreds of millions of downloads. It's called Too Good to Be True. It's two of the best rappers alive right now collaborating. All their favorite beat makers came down and recorded this with them. They threw it out there. It's amazing.
I'm a Sixers fan, so
Okay, so
I'm
you know
familiar
Meek Mill.
with-
Okay, Chris Stapleton.
Oh yeah,
Country fan.
no, but I love Chris Stapleton.
Same.
Yeah.
I'm not a big country fan, but Chris Stapleton's awesome. I've seen him live. The new record is called Higher. Did you listen to it yet?
When did it come out?
Yes, Friday.
No, but I'll get it tomorrow.
4 days, 3
Yeah.
days. Yeah. Absolutely worth tracking down and making sure you have it. Michael, what do you got for us?
I got nothing. I'm
All
sorry.
right.
I'm in a bear market.
You did a great job today.
Thank you.
Hey guys, make sure.
Hey everybody.
Hey everybody. Make sure you are leaving us ratings and reviews. We appreciate those on whatever podcast platform /YouTube. And make sure you tell everyone how much you love the show. Very important for the algorithms. We want to let everyone know where they could follow Kevin Simpson. Kevin, what's the best place for people to get more of your insights?
I'm on LinkedIn.
Okay, same.
And I'm on Twitter at Covered Calls.
At Covered Calls. Are you very active on either of those?
No.
No. Well, a little bit active, somewhat active?
Not really, but I have some people that put stuff up on.
Attaboy. All right. All right. We had a great time with you today. Thank you so much for coming by. Thanks for listening, everybody. We will see you next week.